welcome back to the channel. I'm Ryan. Today I'm going to be talking about what is a SPAC. So recently SPACs have been super hot. They're all over the internet. A lot of people are investing in SPACs, but a lot of people don't know necessarily what is a SPAC. So today I'm going to tell you exactly what a SPAC is, and hopefully by the end of this, you'll be able to understand exactly what a SPAC is, what it does, why people are investing in them, etc. Okay, so I pulled up my presentation here that I made for you guys. What is a SPAC with Ryan? Let's dive on in. So what is a SPAC? Well, so a SPAC simply stands for a special purpose acquisition company. So as you can see, it's a special purpose acquisition company. So that spells out SPAC. So what does that mean? Well, it is a shell company or a blank check company. So what does that mean? A shell company is an organization that doesn't really have operations. So think if I were to start an LLC and I just put money into the company, but the company's not selling anything, the company's not making anything, it just is a blank company with cash in its account. That is what you should think of a shell company as, or a blank check company as. So the goal of these shell companies is to raise an initial public offering. So what is an IPO? What is an initial public offering? Well, an initial public offering is when a stock goes public. So Facebook, Google, they're now all public. The way that they go public is via an initial public offering. So what that is it raises funds for the company, Facebook, Google, etc., these big companies, so that they can receive money in return for selling shares to the public. And then they take that money and they go and use it to maybe market their business, grow their business, whatever. So that is sort of the traditional way of an IPO. The way that those occur is via Wall Street with investment banks. So an investment bank takes Google or Facebook public, and the way that they do that is they go on a road show, they go around the country, they raise money, they get investors, institutional investors, big investors, in order to get money for them to sell shares to those people and then also sell shares to the public. So the goal of a SPAC is to acquire a private business like Google and then take that business public. And what will remain is just Google or Facebook, etc. And the shell company will dissolve. It has been around for a long time, but recently they're very hot because basically with the pandemic and the market tanked a bunch, companies that wanted to IPO were fearful that if they IPO'd, then their stock was going to drop a bunch. So they wanted to go the IPO route with a less traditional way. And the way that has been is a SPAC. SPACs have been around for a very long time, but not until recently have they really been a huge deal. So the goal of a SPAC is to acquire another company, a private company. And some examples is like DraftKings, QuantumScape, Virgin Galactic, Lucid Motors recently just went public via a SPAC, CCIV. So Diamond Eagle Acquisition Corp is now DraftKings. So Diamond Eagle Acquisition Corp acquired DraftKings, and then the surviving entity was DraftKings. And so Diamond Eagle Acquisition Corp is no longer a company that you can trade. At one point you could buy Diamond Eagle Acquisition Corp for $10 per share, and now DraftKings is trading at like $62 per share. And so I'll get to the financing and the share price, etc., coming up soon. But to give you an example, DraftKings was previously Diamond Eagle Acquisition Corp. QuantumScape was previously Kensington Capital Acquisition Corp. Virgin Galactic was previously Social Capital Head Sophia. Lucid Motors was previously Churchill Capital Corp. IV, because it is their fourth fund that they have raised. So let's move on. So why go public via a SPAC? So why would DraftKings or Virgin Galactic or these other companies go public via a SPAC? Well, for one, Virgin Galactic, it was very difficult to essentially value the business of Virgin Galactic. It was a pre-revenue business that had huge ambitions for space travel to essentially allow you to to beam up to the stratosphere and get to Japan in like an hour. But that technology, while is being curated and implemented and growing, it's not actually receiving revenue at the moment. And so the reason why Richard Branson teamed up with Chamath was that he basically wanted to go public, but he wanted to avoid the IPO roadshow, where you take the traditional investment banks, IB banks, and go across the country and raise money and have to go to institutional people and pitch on why your stock is worth what it's worth. And then they're going to come back and tell you that it's valued at this. And essentially, it's really like a lot of sort of regulation, and it's a more difficult process to go through a traditional IPO. And so it was much easier for Virgin Galactic to go IPO via a SPAC. Other reasons why people like SPACs, if you're a company that's private, is because there's a thing called a lockup. So when you go public via traditional IPO and you're the founder, let's say you were like Jeff Bezos for Amazon and you went public. Well, for the first 180 days that your company's public, or 6 months essentially, you're not allowed to sell your shares of your stock. And so that can be a hindrance for a company that's private that wants to go public. So sometimes, companies like, again, Virgin Galactic with Richard Branson, who has already taken a bunch of companies public, he has owned a lot of different companies under the Virgin brand. He just sort of really wanted to avoid the 180 day lockup. He wanted to avoid the roadshow. There's less regulation, and it was much easier for him to go public, and it was a much less struggle for people to try and value his company. So this is the explanation for why a private company would go public via a SPAC. But how does it work on the other end for the shell companies, for the companies that's acquiring the private company? How do they come to get to this position? So you usually take a team of like institutional investors, Wall Street professionals, former CEOs, former COOs, head of product at certain tech companies, private equity people, hedge fund people who have been in the investing game for quite some time. They come up with a team, and then that team goes and raises money. And they raise money from a bunch of different early investors, people that have a lot of money who get into the game early. And those people are going to fund the blank check company. So think of it as you have a separate private business who has no idea that they're going to be taken public by this group of people who have created a shell company. But then eventually this private business is looking to go public, and the shell company is like, we like what you're doing. And the private business is like, well, I want to go public. And they're like, okay, so we're going to merge, we're going to acquire your business, and then your private business is going to be what remains. So it's basically used with institutional investors with track record of success, Chamath. There's like Bill Foley, who's doing PaySafe. There's a lot of different people that now have a SPAC. I mean, there's tons of SPACs. So let's move on. So us as public retail investors, why would we invest in the SPAC? Well, so SPACs are protected by a cash balance. So the money raised by the early investors, the hedge funds, the institutional investors, Chamath, the private equity, et cetera, type people, there is a bunch of cash sitting in that shell company. So you buy shares at $10 per share, and it's actually backed by cash. And that's called the net asset value of the SPAC, and typically starts at $10 per share and starts trading at $10 per share. So if you look at SPACs today, a lot of them are priced around $10 to like $12. And so what happens is once the SPAC goes public, people look at the team, they'll start to buy the shares immediately because they'll see, oh, this CEO, this COO, etc. is now has a SPAC. So I'm interested. I think that they're going to find a good private business. Once they find a good private business, they're going to run it well. So that's a sort of way to think about like why people are buying into SPACs. They're buying into teams of professional investors that they think will go out and find a good deal. The time frame for SPACs is about 2 years, right? So they have 2 years to find a company to acquire. If they don't find the company, then the money literally is returned to you. Then your money is returned to you. Also, it's worth noting that you can buy warrants, which are like an option to purchase the stock if you like the deal. So it's trading at like, a SPAC is trading at like $10 or $11, and you can pay $2 per share in order to get a warrant, which will allow you to purchase the SPAC back at like $11, okay? And if it goes below $11, then you probably don't want to purchase back at $11. But if it goes back up a lot, then you probably want to purchase at $11. So it sort of gives you this option, which is a right, but not an obligation to purchase something. And so there are a lot of people who are just warrant investors with SPACs. Let's move on. So what are the risks? Well, obviously there are the risks that we're investing into an unknown company. So you're putting your money into a team of investors who don't actually have a company lined up yet, and you're trusting them to go out and find a good deal. So what also needs to be noted though is that the incentive structure favors the early investors because they actually take on the most amount of risk. They're putting up the most amount of money. So the people that pool together the blank checks and all the money at the beginning are the early investors who are taking on the most risk. And so if they take a private company public, they get paid a lot of money for just doing that. So the incentive structure allows them to potentially just go out and find any sort of deal. Because if they don't do a deal, then the 2-year lapses, then nothing happens, and they probably don't get another chance to go out and create another SPAC and do another SPAC. So they are incentivized to do a deal. Also, they can sometimes lose money when they don't do a deal because they went out and raised all this money, they went out and did all this time and effort in order to create this process, and then they didn't do a deal. Something else that could occur, there could be a bad acquisition. I mean, think about it. If they're incentivized to just go out and do a deal, then they might just acquire anything. They might go acquire, your local sandwich shop at the end of the day because they need to do a deal. And that could end up being a bad acquisition. Your $10 per share would certainly drop if they do a bad acquisition. And so there are a lot of SPACs out there. People are talking about, well, is there even enough private companies for the amount of SPACs that there are being raised today? I don't know. That's a whole nother discussion. But that is something that's worth noting, is that they could do a bad acquisition. The other thing, which is sort of ironic, especially in today's world, is there's less regulation. And that is a risk because with less regulation comes essentially, maybe a bad deal, or there's not really as thorough of a vetting process. When you go to a traditional IPO via investment banks, there's a very long-winded vetting process. You have to go on your roadshow, you have to convince a bunch of institutional investors what your company's worth. They come up with a price per share, and then you go public at the price per share. And your goal is to have your share pop on that first day because the public wants it and you priced your share correctly. The downside is you price your share incorrectly and then the stock drops. And so the regulation actually is favorable to some people when it comes to IPOs in terms of like the public investors or you and I as the retail. But for private companies, who just want to go public the way that Virgin Galactic did, then maybe a SPAC makes sense. So that sums up pretty much everything about a SPAC that I can think of in a short condensed video. I appreciate your time. If you like this video, please hit the like button as well as subscribe. All right, thank you. Have a good day.